And a very good afternoon to you. Thank you for joining us again as we all work through this very difficult time. I'm Andrew Horowitz, and I am the president and founder of Horowitz and Company. And hopefully everybody is doing well out there. Everybody's healthy, and your families are doing well, etc. Well, there are a lot of things to talk about. We have an extremely busy week coming up, and a lot of things that have happened, obviously, over the weekend. There are some signs that maybe a plateau and new cases are coming, but there's also been an alarming report of ICU capacity and deaths throughout the country. I'll mention to you before we go any further, please, everyone, can you do me a favor and ask all your questions in the Q&A panel and not in the chat? That would be very helpful. Hopefully everybody can hear me okay. Somebody mentioned that they couldn't hear me. Hopefully, oh, we're good. Just got a notification. Everything's good. So before we go any further, I want to mention that this is for educational purposes only, and it's not a recommendation to buy or sell any security. Past performance is not an indication of future results. And again, we are just here talking amongst friends about the questions you have regarding finances and investments and the markets and what's going on and what could be. And we're doing this together each and every week on Mondays at 4:30. So with that, I'm going to also mention that any questions that you have, I want to make sure you're really comfortable here because this is a safe environment. Any questions you have, you can ask. Just put it on into the Q&A. I may not be able to answer some of them or many of them. I'll do my best to get you some information. But let's talk a little bit about some of the things that transpired over the last week or so and get an idea of what we're looking at for the week ahead. So I think one of the things that we saw the last probably 2 weeks, and even today, as a matter of fact, there was some information from Johnson & Johnson that they're starting trials on human candidates, so individuals, not lab rats or mice or anything else, of a new vaccine. We saw that Moderna came out 2 weeks ago. They posted a pretty decent study. Then we saw also AstraZeneca last Monday that said that, hey, you know what? Things are looking better. We're moving closer to the next stage of the overall end game, which is obviously to get a vaccine. Now, however long that takes is anyone's guess. If any of these actually hit the mark and continue to provide for the targets that they have of creating antibodies for the COVID-19, again, there is only hope for that. And even if we get to that point, a lot of people are asking, well, if a vaccine comes out, let's say even in January, if that's even possible, is that going to be, number one, in time? Number two, what kind of scars are going to be left on individuals, psychology of consumers, as well as the population at large? And at that point, how many people will be willing to take a vaccine that went through the approval process as quickly as this has, when usually the FDA process of new drugs takes years, not only for safety, but for efficacy in terms of the ability for the drug to do what it says it's supposed to do. But obviously a lot of people will be willing to say, you know what, the hell with it. How much worse can it be than actually having to be, held hostage in my house, not be able to work, do the things that I do, have fun in life? Because you know what, for a lot of people, let's be honest, this is not just necessarily about, oh, I'd like to get back to work. It's really about getting back to life, to living. The unfortunate circumstances of this particular event has precluded many of us from doing anything but maybe doing some work during the day, whether it's at your house or maybe if it's a safe office environment, and then just going back home and having Zoom meetings and having Zoom cocktail parties and playing games with family and friends online. So it's obviously a major change that no one likes. Maybe there's some people that like this, maybe, but for the most part, I would think that people are just fed up and done with this. There is a incredible amount of, I would say, this angst, and people are getting pretty fed up with this. So there's hope in the markets for the potential for a vaccine. And we clearly know that there's been a lot of discussion about stimulus. The Republicans offered up just a few minutes ago that they'd like to provide $1,200 per person, I guess if they qualify, in stimulus. It's about a $1 trillion package, $200 per week on top of the regular state instead of the $600 per week unemployment compensation for some period of time. I believe the Democrats are going to probably say that's not enough. Also, money for vaccines and for development of new drugs, as well as help for states and hospitals. And there's a variety of other things, but those are the headlines there. But something is going to happen because we know that the $600 per week ran out this or the end of last week, depending on the state and all that, but basically ran out. It's over. So a stopgap needs to happen because over the next week or so, if nothing's done to automatically put that back into play, consumers that are out of work right now and don't have an income are going to be hard-pressed to pay what they have as far as bills and all that. Now, there's a lot of other little intricacies here, right? So we have things like the moratorium on foreclosures and evictions and the forbearance on mortgage payments. All that's kind of running out right about now. Nobody expected this to be going into July or even into August. So all the plans were put as far forward as they could, but it's not getting there. But with the stimulus, it's going to be there, and we have that there's money flowing into the markets. Every crevice of the market seems to be reacting. And whether it's because there is the implicit warranty, guarantee, safety net, invisible hand, whatever you want to call it, from the Fed, that is going to do whatever it takes, whatever it's going to be, it's going to be. It's going to be more bond buying. It's going to be low interest rates for an elongated period of time, maybe forever, quantitative easing programs, and that's starting to spill over into markets. And as a lot of people are thinking that this is starting to get a little bit bubbly in some areas. And when you start to push further and further into the markets, and this is not anywhere to put the money, it starts flowing in other places. And I want to show you what that means. Over the last couple of weeks, we've seen an incredible amount of money, it seems, flowing into things like hard assets. This is a chart that you're looking at on your screen of gold and silver. It's showing you from the beginning of 2020, the percent change, the performance of these precious metals. And look primarily at the big drop we saw. And we saw that, of course, just like every other asset where cash was being raised. Gold, not so much. We went from about 10% up to about 3% down. Silver got clobbered, down 30%. But the rise since then has been pretty steady, I would say, along with the markets. But in the last week or so, look at what we've seen in the last week or so, where we've had this incredible move that has been, I don't know, what can we call it, a stampede into the markets, into gold and silver. We're talking about, if we just say that there was a plus 5% return on silver right about here, right about this line right there, and now we've gone up, and it's up 35%. We're talking about a 30% move in the last 2.5 weeks on silver. Gold's not doing so bad either, picking up very nicely, but only went up from about plus 18% to plus 26%, right about in this range. So the good news is that we're seeing some real opportunity here. The bad news is, and the question you have to ask yourself, why is this happening? Is it because there's inflation on the front? Because, if in fact we think about this just for a moment, if we snap our fingers and just say all of this is over as of right now, and even considering no more stimulus from the fiscal front, from the government in stimulus checks or unemployment insurance, nothing, everything, and everybody starts to go back to work. Come right now. All that excessive amount of money that's being pushed in from the Fed in the bond buying programs, interest rates at record lows across the curve pretty much, is causing a lot of bulging of areas. And if that's not enough, you have to look at the fact that we even saw Bitcoin starting to go parabolic again. Bitcoin was, I think, closed above 10,500 today. This is the same chart, and all I did was add Bitcoin. And I added the Bitcoin chart, which you can see it fell down right with stocks. So this whole idea that, by the way, Bitcoin is a great diversifier. I mean, it did the same thing as gold and silver to a greater degree. I mean, if Bitcoin started up the year up 50%, then went down 30%, it's about an 80% top to bottom move on Bitcoin. Not a good diversifier, because what you wanted to see was this inverted. And what's happening now? Well, it's just going up with the markets with the speculative action that we're seeing, up 48% year to date, with the move on that last part right here, those last few weeks of July, looking very similar to gold and looking very similar to silver. So I don't think that Bitcoin, for all that it's thought out to be, and this great diversifier, store of value outside of the currency, is really any better right now, we can say, from gold or silver. People looking at this as, hey, maybe this is an alternative asset to get away from the U.S. dollar that's being debased by the amount of debt that we have. And okay, I'll go there, because don't forget this Bitcoin compared to USD. Bitcoin is always in the USD terms. So it is possible that there is some level of anxiety about the U.S. dollar and where we're going. And think about one other thing. I think this is really important. With the new PPP on the table and discussion of unemployment benefits of $200 or so per week, and helping out the states and the hospitals and testing programs, the Fed continuing to apply its, the pedal to the metal, keeping that gas pedal down on the floorboard, and with the FOMC out on Wednesday with their rate decision and probably doing nothing but talking about the fact that they're going to extend this whole thing and keep the kitchen sink tactic going. Maybe there is the thought that there is a bigger concern about the U.S. dollar, which has been down now about 7% in the last several months. And, if you look, and probably this is up for debate a little bit, but if you look compared to the rest of the world, where we are in the United States versus Europe, Asia, maybe not so much Latin America, let's take Brazil out of the discussion and some of the other countries, but around the world, we're looking like we have the worst situation here that doesn't seem to be getting really much better. Yeah, we're seeing a little plateauing in certain areas in Texas and Arizona and Florida, while now, from new case standpoint, while the cases in ICU beds are kicking up a little bit, as I mentioned, as well as the death rate. But still, when you're seeing zero numbers in some states around, some countries around the world, and even though they may be doing less testing, the fact remains that it seems they have this much better under control than we have it here. Well, we're all bitching and moaning about whether or not we should be wearing masks or not and take away my liberties. They're just doing what they're supposed to be doing, or got this under control in a different manner with contact tracing, which we would never be able to do here. No one would stand for having, or very little people, very little amount of people, I would think, would stand for having the government tracking you and your friends on your phone. I just don't think that's going to happen. So for whatever the reason is, really doesn't matter. For whatever we want to argue with, the tests are flawed in this way or not, I think we could probably all agree that just looking at the official numbers across the board, the U.S. has it worse than everywhere else. And that being the case, maybe that's why the dollar is down. Maybe that's why gold is picking up so much. Maybe that's why silver and Bitcoin are doing really well, because as we're seeing the potential for more stimulus, and those actions are negative for the currency. If we take our country and look at what the GDP number is going to come out on, I believe it's, I think it's this week on, I forgot, it's Tuesday or Thursday. Well, GDP is coming out this week for the second quarter. Estimates for a negative 35% for the year over year annualized. That's pretty ugly. Now, obviously, we're not going to see that in the third quarter as the reopenings happen. Maybe we'll get a kick up of 8 to 10%, because it's just natural when we go from a number like a negative 35%, which, by the way, will be historically low, the worst GDP number ever. We go from that to the next level where we're going to have a reopening. We're going to see a much better number come out. So it's important to understand where we are and what's happening here, and the potential also, which we just can't put aside the fact that a dollar on the downtrend is actually beneficial for U.S. multinationals. So that's a good thing. It may not be good for us buying products from other countries, but you know what? It is good for our multinationals here that have to buy products and then turn them into something else for the finished product for any manufacturers here. Now, in terms of the markets, 128 approximately as of the close on Friday, 128 companies reported earnings from the S&P so far. This week is going to be monstrous with another 100-plus companies. What's interesting to note is of the 128 companies that already reported, we have 80% have been able to beat the low bar analyst expectations that were put forth. But if we look at the actual numbers, not the top line headline, not the bottom line headline, not just the revenues, not just the earnings that are always put into, oh, well, they beat, they did this, they did that. Well, if we look a little bit deeper, some pretty horrifying numbers and the changes from 1 year ago. You take a company, for example, like American Express. Now, obviously, they're in the travel-related business, also in the credit card for spending and all that. They saw a drop of about 80% or so of their overall earnings from a year ago. And a lot of other companies are also seeing big drops from a year ago. So when you have that in a, I don't want to say normal, but in a usual market condition, obviously we'd say, well, we shouldn't see those stocks at all-time highs. Now, American Express is not at an all-time high. But we are seeing that companies in general are showing a very significant drop in earnings from a year ago. Now, is that going to pick up into next year if we do have a reopening? Yes. Remember, when we first started this, we talked about the first quarter being questionable, and the second quarter being a problem, third quarter being much better, and then it will get much better from there. However, we didn't think we'd be talking about the potential for not back to totally normal by July or August 2020. Today, Google came out with an announcement that they're continuing with their stay-at-home work requirement. In other words, work from home, hashtag WFH, until the summer of 2021. An entire year from now, Google has now said that their workers are going to work from home. We saw that Twitter said indefinitely. Now, maybe companies are saving some money somehow. I don't know, maybe electricity, lunches, perks. I don't know, maybe they're saving some telephone bills. They're saving something. So it may be better for them to do so. But think about the implications of that kind of situation that we didn't even think was possible just 2 months ago, even a month ago for that matter. So here we are. And here we are, no different than we were. So right now the plan for companies is this. Companies are going to put out some numbers, and basically they're going to beat analysts because analysts have really lowered the bar substantially, and they're going to have a headline usually that is going to be a beat, going to read all good things. For example, Intel. Intel came out with earnings last week. The headline numbers, pretty good. Guidance, on the other hand, and product delays with their 7-nanometer chip were issues. Stock was down 17%. Initially on the print, before the guidance came out, and they did provide guidance where a lot of companies aren't, what we saw was that Intel was bid up 4 or 5% until the reality hit. So what we know is that there's a lot of action being tied to what is just the headline. And what does that mean? What does it say when a stock moves dramatically on the headline without getting all the full information? What that is retail investors that really have no understanding of baseline fundamentals. And we could argue all day that the smart money and dumb money and who's doing better. If you think that fundamentals are out of control, then you took your money out of the market in, I don't know, April, because it was just getting crazy, or in February for that matter, before this all happened, and you didn't get back in. Well, you're a loser, right? Because look at all this great opportunity that happened here. On the other hand, when we sit here now, when stocks are close to all-time highs, or at all-time highs for the S&P 500, and maybe the NASDAQ, not the Dow at this point, and clearly not an equal weighted composite of the S&P 500, clearly not the small caps. So when we look at the fact that the dollar has been dropping, and valuations are a bit lower. And the good news is that, yes, our clients have positions that are benefiting from the gold and the silver move. In the TDI Managed Growth Strategy, we have two companies in the portfolio that are in the gold space doing wildly well. And in our managed growth in our global allocations and in our investology, we have commodities. And inside the commodities space, there are precious metals as well as industrial metals, the copper, the nickel, the zinc. So we are participating in this area. And that's why, if you've heard me talk about this before, on a regular basis, I say it's like my go-to anxiety position. What to do with commodities, because they haven't been doing well for so long. But then I step back and look at a longer term historical reference and realize that commodities have had some great, not only diversification potential, but great return potential over time. So we are participating with this, and it is one of those alternative assets outside of equities and bonds, let's say, or cash or real estate, that does make sense to have in that diversification process. And I talked a little bit about the whole concept of what is diversification. I entitled the podcast this week, Am I Diversified? After that little funny game show that Jim Cramer does on Mad Money on a regular basis on CNBC. And I just thought we would talk about, hey, am I diversified? And what does that exactly mean anyway? I mean, I have 4 stocks, and one's in the consumer discretionary, one's in energy, one's in technology, and one's in communications. Am I diversified, Jim? Jim takes out the little pencil. He writes down on a piece of paper. He looks at it like he's really studying something and says, yes, but, instead of having this position in your staples, I want you to own Clorox instead of Procter & Gamble or something like that, right? So what's happening now is, I think, a need for good diversification. And this is one of the areas, and that's why I keep on leaving this up on the screen, which I'm going to take off now. So one of the big things, though, I just want to mention before we get to the questions, and you can continue loading those up into the Q&A panel right now, any questions that you have on any of the topics we're discussing here or any topics that are on your mind, is this, that one of the things we're considering right now, we're looking at very closely is, okay, if the valuation prospect for certain areas within the U.S. equity market is such that there is a very little stretch value left in it, where do you go if we want to get that equity exposure? And we're starting to think about, if the dollar is low as it is right now, and maybe if we're going to continue having difficulties here and the dollar does continue to take a little bit of a plunge, and even down 3, 4, 5% more from where we are, what benefits from that? Well, we just talked about gold and Bitcoin and certain commodities. Okay, fine. What else? Multinationals, great. Well, what about emerging markets, emerging market bonds, developed market equities in certain areas around the world, especially if they have a good head start against us or against U.S. stocks in the fight against this disease? And if, in fact, we were to get a vaccine tomorrow and the world starts to get inoculated, won't they have a much better stretch to run maybe than U.S. equities? So we're starting to think about shifting a little bit into that positioning right now for our portfolios, particularly investology and the global allocation strategy. It may not be overnight. We really kind of want to look at a few more characteristics of this, what the holdings are, and kind of get a little bit through earnings season to see how that plays out. But basically, that is something that I want you to think about and consider. The other thing is, I'll mention that on Tuesday evenings, John C. Dvorak, myself, get together for I think it's a fun and a little bit lighter side of finance. We get together on Tuesday nights at 9 o'clock at dhunplugged.com. There's a chat and a live stream that happens right there. Something that you may want to take a look at and I think is pretty interesting. But other than that, we are continuing on with some great guests that are coming up. We had a little bit of a dry spell with guests for a couple of different reasons, but that's okay. We're going to get some more guests back on the Disciplined Investor podcast. Thank you so much for being a part of that as well. Any communication that you want, right on the bottom of this slide, you can see right here, there's an email. I'm doing a little circle around the email. info@horowitzco.com, or you can give us a call if you have any questions about your portfolios, or you just want to chat, see what's going on, etc. All right, let's get to the questions. All right, let's start here. First question up is, it goes like this. I often put a trailing stop on a stock using my online broker, which is TD Ameritrade, okay? I do this in hopes of capturing some of the upside and not getting killed on the downside. Why do some folks say you should never do this since big money can see your stops and game you? I think, actually, trailing stops are a little bit different because they're constantly moving, right? Constantly moving up and down. They're talking about sell stops. There are some brokers that will advertise, and there are some algos that can see some of the sell stops. And a lot of times sell stops are put at very inconvenient levels. So for example, stock trading at $40 and 92 cents a share. And people are very concerned about, okay, well, what is the number that I should put on? They say, well, if it goes below 40, I'm really concerned. So they put the stop at 40. The problem is that 40 is a really bad number because it's a round number. And I know this sounds a little ridiculous, but the stop hunters, if there are algos out there that are going to try to chip down the stock price and figure out if they can blow out a lot of stops and then buy underneath, so maybe they're going to put their price on the buy at $39.72. They're willing to buy it. And the stock comes down in the morning because the markets are off or something like that. All these stocks, all these people put their round number stops in at 40, blows them out. They get to pick it up at a lower price, maybe far below what the level was. So I don't necessarily think that the trailing stop is as much of a problem, but there are some ways, and there has been in the past, some ways for stops to be gaming you if you have them at certain levels, and depending on your broker, if in fact they're advertised. It all depends on what you're doing, how you're doing it, and your broker. So I would call up my broker and ask them, hey, is there any advertising going on with my sell stop orders? And remember something. The other thing about stops, there are stops, a sell stop, and there's also a sell stop limit. A sell stop says, hey, if it hits that price and it ticks down to that level, the next trade, whatever it is, I don't care whatever the trade is, I'm going to sell it. So you could be, I don't know, it could be a market order at the next price. A stop limit says, hey, I'm willing to sell at 40, but not below 39.92. So that becomes a limit order at that point. And there's some problems with that as well, potentially. But good question. Thank you very much. Doug asks, what do you make of the move in gold and silver? Oh, commentators often discuss the recent strengths in relation to the strength of the dollar and the possibility of inflation. Why? I think we covered that. In the discussion today, Doug. Hopefully you heard all about that. There is a relationship because it is priced in dollars, and there also is the relationship that the thought of, hey, if I'm getting out of dollars, what other type of alternative currency can I get into? And that was the discussion about, Bitcoin, right? That was supposed to be an alternative currency. So here's a question. What do we make of Moderna, symbol mRNA, insider selling stock, every press release regarding the possible future of the COVID-19 vaccine? Should this be investigated, or is this par for the course as a high-flying biotech stock? I've never had luck in this segment, always get it wrong. Yeah, it's interesting because I saw a chart today, and it showed all of the insider selling for this stock. And this stock is an interesting situation. They just got another $492 million from BARDA, which is the government's arm to provide for this vaccine research. I think they're probably up to about $1 billion now. So either somebody has a lot of faith that Moderna is going to come out with a vaccine, which they've never had a vaccine before, they've never made any money before. This is all, theoretical here, but supposedly they got something that's pretty good. Or something weird is going on. I will tell you that there is probably somebody's looking into this. One of the things to note is you have to separate the selling from the scheduled selling. Now, that may or may not mean anything, right? Because if you have a scheduled sale that's already, the insiders have a scheduled sale, let's say on the 15th of the month, and they decide, you know what? We know that sale's coming, so let's put out something great on the 13th. That's a problem. If, in fact, they're just selling after the stock moves up, well, you have to wonder, well, if the stock is moving up because there's good news, and here's the question you need to ask. If the stock is moving up because of good news that was just released by the company, why would an insider sell? Now, it's possible that the insider wants to take a little bit more money off the table and diversify. Not unreasonable. I don't think that's unreasonable. But if it's to be looked into, I think it's going to be looked into, and I understand your point there. Please do me a favor, ask your questions again. We only have a few more left today. Packed house again today, but less questions. Interesting. You can have questions on bonds. You can have questions on stocks. You can have questions on the commodity space. What's going on with the earnings this week? What we're going to see from companies like, who's coming out this week? Is Facebook coming out this week? Microsoft we saw last week. Amazon, I believe, is this week. Google, a whole host of them coming out. Next question. Hey, Andrew, the market seems to believe that the Fed will create a highly inflationary environment, but the existing debt and yet to be realized bankruptcies should be a huge deflationary force. Do you think the market has it correct? Do you think that the current trend will persist past the election? So let's take the first part of that, because that is really important, and I think it's something that's overlooked, and I agree with you, Carl, is what is going to be the implications of not only the bankruptcies, but what's going to be the implications of if, in fact, we see that people have to start paying back their not back their mortgages, but start up their mortgages. I mean, the amount of people that have not been paying mortgages, their payments, because they had requested forbearance on their mortgages for, I think it was 4 months or so, is coming to an end. And I don't know if there is a way to really figure out, well, how many of those people are not going to pay in the future, because we really haven't seen any significant move in the real estate market, except for up recently, on the new home sales and all that. And if you look at the home builders, are doing just outstanding. Many of them are doing outstanding, having some of the best opportunities as people want to leave. And this whole move, this de-urbanization from the metropolitan centers to the suburbs and single-family homes with a little bit of a backyard maybe is there. So people don't ever feel like they have to be caught up in a situation where they have to take their dog down the stairs, down the elevator in this kind of environment. Now, who knows if this is a 100-year event or it's an every 3-year event. Let's hope it's a 1,000-year event from this place forward. But the bankruptcies are going to be huge. They're starting to roll in. The fact that we're going to see credit card and debt losses are going to be significant, except for where the Fed is coming in to provide a backstop. And the Fed has made it very clear they're going to provide a backstop to everything that they can possibly do. And they're not stopping. They've gone above and beyond right now buying individual bonds in the marketplace, like Apple's and Microsoft, like they need the money, right? No wonder why Apple stock keeps going up, because they keep on issuing debt at really low rates and rebuying their stock. So I think there is the potential for a very significant amount of inflation due to the fact that there is a lot of money in the system. And at the same time, I do agree with you that the potential for a deflationary environment is also very high due to the fact that we have terrible economics that are going to be here for a long time. This post-virus stress disorder that I've talked about, the PVSD, is going to be very significant. And when we look at this, you have to realize that there's going to be a problem with the low tax rate that we have. So now the end part of your question where you say, do you think that the current trend will persist past the election? You have to break down what's the result of the election. If, in fact, everything stays status quo as it is right now, this is a very market-friendly administration. In a way, maybe too market-friendly, but it's okay. We're all happy-pappy. On the other hand, if, in fact, we do see that there is going to be a change in spending, and some of that spending is going to be paid for, not out of thin air like it is today, but more so by taxing the rich and raising taxes on corporations, which is what they say their platform is, that's going to be a problem. So I think that the big issue right now is that we are in a quandary of a major unknown. Everything the Fed is doing is providing for the potential for a long-term inflationary environment, as this is supposed to be a temporary situation. It is not a structural imbalance. If you go on to the disciplinedinvestor.com, you see our latest quarterly newsletter that I think is out today, that we put out there for the public. You'll see we talked about the various types of bear markets and even recession-related. whether it's event-driven, structural, or cyclical. And it talks about that. And this is event-driven. Structural is where we have the long-term deflationary problem. Event-driven, whether it's a war, natural disaster, or in this circumstance, a health crisis, this is potentially leaning on the inflationary side of things if it clears up in a reasonable time. John J. asks a pretty loaded question here. He says, hey, what is your take on Barstool Sports' Dave Portnoy? I see him on Fast Money, then interviewing Trump. Claims he never traded stocks and now is a day trader. My understanding is that Portnoy has nothing to gamble on, so what he decided to do, and he's a personality. That's why you saw him on Fast Money or on these various shows. That's why you see him in the afternoons on Twitter with a green hammer saying that stocks never go down. They only go up. Stocks only go up. If it drops down a little bit, buy it. He's only been trading for, I don't know, how long is it now? Since March. So he's had a pretty good run right now. You know, one of the things he does is he takes a Scrabble bag and he mixes the letters around and he takes out 3 or 4 letters. And whatever those are, he puts them together and tries to make a stock symbol out of it and then buys it, saying it doesn't matter what the stock does. It doesn't matter what the stock is. So I think that you make your own decision on this. He is a personality. He's selling things like hats, and he's selling, I don't know, mugs, and he's entertainment. Who knows what the real track record is? He's worth about $450 million from the sale. What is it, to Penn National Gaming, and he used, I don't know, he's running $6 or $7 or $8 million on a daily basis, just going out and buying stocks and saying how much he makes, and if he loses, it's just going to come back anyway, so let's just double down. Hey, you know, more power to him. He doesn't care about losing a few $1 million because, you know, he's got $400 million behind it, and you know what? He's probably making just as much money from the subscription to whatever service and whatever he's selling, as well as his brand itself. Next question comes in from L. Is there a way to short an individual bond? Not really that I'm aware of. You have to probably go out to hit the ETFs. You could probably short individual bonds, but not at a low price point. But you'd probably have to go to the ETFs that hit that area, and that's less efficient is probably what you want to do in there. I would probably look to the stock or the preferred if there is on a company and see if you can hit that and hit that short. Jim asks, you mentioned here Intel a minute ago. What do you think of the stock at the lower level? Thanks. So one of the things I talk about, I'm not going to really go into individual recommendations of stocks here. I will tell you that the 7-nanometer chip that they were going to produce and the delay on it really helped out AMD and Taiwan Semiconductor. And I'll mention we own Intel and we own Taiwan Semiconductor. Taiwan Semiconductor was up another 11.5% today, just screaming higher. Amazing company. Intel's a really good company too, obviously. That's why we hold it in our portfolio. Probably Intel's going to be relaxed and released at the end of this period. But I think that when you look at the potential for where the next big chip opportunity is, if Intel is not supplying Apple with their chips in the future, and Apple's going to use their own chip, and then they had this delay, I think there are better options in that area. Somebody asked me, what's my definition of alternative assets? So alternative assets can come in many shapes and sizes. They could be anything that's not related necessarily to markets. So bonds, markets are markets. I'll even put cash into that area. I'll put real estate to a lesser degree. So stocks and bonds, and to a lesser degree real estate, let's call that non-alternative, normal assets. Alternative assets are things that trade outside of the correlation of those assets. So there's things like there's mutual funds, there's also limited partnerships, a variety of places where you can get exposure where they're doing things like credit arbitrage or event-driven strategies or maybe option alternative strategies where they're selling, like an option enhancement strategy where they're selling options against stocks and creating some income and downside protection. So there's a variety of different, merger and acquisition. There's a variety of different strategies within the stratosphere, private deals, that are all there that kind of don't necessarily work with the markets. Now, when the markets take a massive crash and everybody's just going and making a mad dash for the cash and just saying sell everything, everything doesn't do well. I mean, everything, it's a problem. But under normal conditions, if you want to have some kind of overall, I would say, diversification that is outside of just equities, because there's only so much you can get from diversification if you just have stocks and bonds. If you add in real estate and commodities and alternative assets into there, and then you also have a very good selection of differing bonds inside of there, U.S. and international, and currency-based, some that are hedged and some that are not. That's where you start getting that whole alternative asset feel inside of a portfolio, which is what we like. Hope that helps. This is a question of advertising sales. I see many more PSAs on TV and online. I would think there would be some big misses on large TV and online opinions. You know, you would think we see Facebook coming out this week that between all the potential for political environment where they're slowing down on taking some political ads, and the fact that a lot of these companies are doing a pause, as they call it, from Facebook advertising, small companies that are unable to advertise right now, I think you're on the right thing there. It seems like, you know, you watch some stations and it doesn't even matter if there's commercials. They just need to put in 8 minutes of commercials just for the hell of it. So annoying. It's impossible to watch legacy TV anymore, isn't it? But I would agree that there could be some, but you remember something, you're also in political season where the prices go up potentially for political ads, and there's going to be a lot of ads, a lot of money flowing into that, so possibly. Somebody says some exchange-traded funds and ETFs allow you to short a market segment or a sector instead of individual stock. What's your take on these ETFs? I have no problem with that. We use them quite regularly. If you want to do a little bit of a hedging strategy against a larger component of your portfolio, you could use either shorting the S&P 500 or the QQQs. You could short SPY. You could short those, or there are inverses available for them. Sometimes they are directly related or not. But, you know, you could either short the ETF, which is a basket. So if you want to short, for example, maybe tech, you could short a tech XLK, which is a symbol there. Or if you want to short, you know, if you happen to want to short generally real estate, there are a couple different ETFs that you can actually short, or there are some inverse that are out there as well. Tim asks, what percentage of your portfolio do you normally like to use for tail risk strategies? Or you just adjust based on current valuations of the market? I mean, yeah, it's primarily, I don't think there's an exact answer to this. It's really about valuations of the market, I think, is what you're asking here. You know, when we look at portfolios and we look at the broad risk and then tail risk, right? So you look at the fat and the skinny part, and you look at, you know, where are those risks. The skinny part doesn't really, you know, there's trading opportunities around that, right? But it's really the fat tail that is the bigger issue, right? The fatty part of what is coming, what are the issues. And I think you have to look, you know, right now valuations are not the key. It's more technicals. Valuations, it doesn't really matter for many people what the valuations of something is. I mean, just look at stocks like Tesla. You know, look at some of the SPACs that are out there. Look at the companies. As a matter of fact, there was a study I just looked at today, and we looked at very carefully. I'm going to talk about tomorrow night on DH Unplugged about how the zombie companies of the small cap universe have had a much greater return over the last number of months than those companies that are making money. Zombie companies are companies that don't make any money. The small cap universe of companies is about 80% of them, or some ridiculous number, maybe 60% of them right now, don't make money in the small cap universe. Those are performing far better than the companies in the small cap universe that are making money, that are profitable. How is that? You know, what is that about? Something's not right there, right? So when you look at that and you think about what's happening right now, valuations are kind of a squishy situation right now. Because it's like, well, if they're above value right now, you know, maybe next year they'll be better with all the excess money coming in. There's a lot of talk going on, a lot of rationalization happening around valuations right now, which are some of the tallest and the greatest in history. But nobody really wants to talk about that. Last couple of questions here. Hedging one's portfolio has me stymied. Is this really only for sophisticated investors? I know you mentioned you do this for your clients. Hedging a portfolio is just basically, there's a couple of different ways to do this, a lot of different ways to do this. Hedging, I'm going to hedge my risk. So we talk about this 1 foot in, 1 foot out concept where, if you want to be involved in the markets and you want to be involved in some of the risk, but you don't want to put it all up there, well, 1 foot in, 1 foot out. And that doesn't necessarily mean like half cash, half investments. What that means is maybe knocking down your risk factor a little bit so you can play and go along with this, but not have the headache of what happens if. What happens if this goes down 30%? Am I going to be rocked by 30 or 40% of her loss here? Well, no. What you could do is by diversification. That's one way of kind of hedging. A second way is by using alternative assets. A third way is using actually hedging strategies, short positions, options, etc. in the portfolio. So there's a lot of different ways to hedge the risk. The idea here is if you have all risk on, how in fact do you then say, hey, maybe how do I take some of that risk off without necessarily taking all the risk off? I want to participate. I want to play. So, for example, instead of playing baseball with a hard ball, afraid you're going to get smacked in the head with this thing and have a concussion, you put a helmet on. You're hedging your risk. You play with a softball. Little easier to hit. You play with a wiffle ball. You know what? Doesn't go as far, but I'm still playing baseball. And you know what? It's not going to hurt me if I get hit with it. So kind of that's the concept. If that makes any sense at all, anybody. Last question. If you had a college freshman course, if you had to give a college freshman course on investing, what books would you have as part of your curriculum? I mean, there's a lot of ones. Technical Analysis is one from Brian Shannon. What's it called? Different time frames in technical analysis. Time frames. Brian Shannon, 2 N's. Look that up. I would probably say some of the early books on value investing by Benjamin Graham. Clearly, O'Shaughnessy books. O'Shaughnessy on what works on Wall Street. That's just a great quantitative filtering screening book. Also, Graham, of course. You have to look at his books. Benjamin Graham. There was something else I was thinking about. William O'Neill. How to make money in the markets. So those are probably some of the best ones that I would look at. Market Wizards also great. We've had a lot of these people, by the way, on the Disciplined Investor podcast. We got to get them back. Some of these authors, some of these people. Well, some of them are not alive anymore. But I think that these are all interesting. And I think give you the bedrock and framework for what that. Yep, reminiscence of a stock operator. That's an early one. That's the early days. That's really how to be a stock operator. A great one on risk. The end of that story was interesting, but that one also gives you a really good idea, and it's a very fun story about the risk that is taken in the early years of the 1900s. So anyway, thanks everybody for joining me. Please be here next week. Tell your friends, tell your family. We're going to be here for you as long as there's interest, as I mentioned. And we're going to put up this recording probably tomorrow on thedisciplinedinvestor.com. Thank you so much for joining me. Have a great week. And I will see you again tomorrow night for DH Unplugged. Of course, this week for the Disciplined Investor, as well as next week on Monday for another action-packed pop-up webinar. See you then. Thanks.